Well, here again, Neil, and we're now in the second quarter. Few slightly nicer days. MIPIM in the rearview mirror. And the word on everyone's lips is?
Well, Brexit is one of the words, definitely.
Well, certainly one.
And it's slowed down, for want of a better word. What's happening in the market?
What's happening in the market? It's certainly true that volumes are off, but the comparatives aren't terribly helpful necessarily.
They're not. We've been saying for a while, UK investment fell quite a bit, probably this time last year. Q4 2014, Q1 last year, with the big ones. Things have come off the boil, definitely since then. It's not taken a dramatic turn down this year, although things feel a bit quieter.
Yeah, and you can look at the headlines on, and there were some particularly big student housing deals in the first quarter last year, which obviously aren't in the figures this year. I mean, in Germany, which had a knockout year last year, volumes much, much higher. Well, it's hard to keep that kind of momentum going. So you've got some tough comparatives.
That's it. Student housing portfolios is the other big one. Seem to have disappeared for whatever reason. But we've got this question, what's going on? Is this the demand for property falling away, or is there no supply?
It's interesting. I've had 2 conversations in the last 10 days that point towards there being at least as much of a supply issue as any kind of demand issue. It's certainly true that if you talk to people on the buy side, their willingness, their ability to make a big decision prior to Brexit and so on, the Brexit vote, is probably not great. But equally, look at where we are now. We're in April. Actually, to get to the point where on anything significant where you're genuinely committed and you're going to be going through to before that date isn't really an issue now. The timing's through. But the 2 conversations, one was with a major UK investment institution. We were talking about the open-ended retail property funds, which are getting quite high cash allocations. And one of the managers was commenting that whereas their proportion in cash was at the lower end of perhaps that fund universe, some of the others were getting quite high, and there'd been some coverage in the press saying, is this because people are worried about a run on the funds? And the manager saying, well, no, actually, I don't think that's the issue. I think the thing is that they've still been taking money, and if you went out to actually spend any,
nothing to buy.
There's nothing to buy.
Does that mean there's no Brexit effect?
I think the Brexit effect is at least as cautious on the sell side as it is on the buy side. Is someone going to make a decision before Brexit? No. Will I put my property out there to sell, thinking it might be difficult to actually sell it? Will it be tainted if I put it on? Therefore, everybody's holding back. But equally, the other conversation was that, we've actually taken a £500 million portfolio to market, and one of the rationales there was actually there's still quite significant buy-side demand, and there's not a lot to buy, so it's the right time to go.
Trying to balance itself. I mean, we've had quite a few things happen in the last year. That's why it's so difficult to disentangle all these things. We had stock markets go way down, come up a bit. I think arguably you look back and it's trading within a broad band, but at the time it doesn't feel like that. We've seen corporate bond spreads shoot up, we've seen them come down. All of those things affect the mood. They affect buyers and sellers, as you said, not just here in other countries too. It's not the Brexit that's driving the German volumes down. It's because our guys there say it's the shortage of stock, exactly what you're saying. In that case, because everybody wants German stock, why sell it? It's slightly variant on the argument. But where are we now? I mean, at the moment, my feeling is that we seem to have gone through a period of troubled waters, and we seem to see a few sort of calmer days ahead. Is that right?
Yeah, I think if you look at things like the VIX, and the fear index, as it was being dubbed at one stage, which is a measure of the volatility in equity markets, that's come off a long, long way. You've certainly seen credit spreads come back down. You've seen some small recovery in listed stock markets. Interesting that the European real estate names are now above their levels of the second half of last year, which you certainly can't say of the UK names. They've bounced really quite strongly. There does seem, that kind of pressure cooker type effect on fear and uncertainty does seem to have come off quite a lot. But you are still in an environment where you've got low commodity prices, you've got lower long-term expectations for interest rates because people are less sanguine about how much growth there is in world economies. You've got quite a lot of political effects out there. I mean, you've got arguments in Germany, you've got significant political issues in Poland, You've got a hell of a lot of political fun and games in America, even if it's just the usual 4-year election cycle.
It's looking like it might sort itself out.
But they are having fun. You've got to admit they're having fun.
Yeah.
And we've got our own little local difficulties, with the word that we've said too often in this conversation already.
Yeah.
So all those things point to uncertainty. And I think the decision-making effects on, do you deploy? Equally, do you bring something to the market to sell? I'm reasonably confident there are a number of quite significant situations across Europe where people were very motivated to sell, where they're now much more talking about refinancing and things like that. We can hold a great cash on cash, looking at where our entry yield was, valuations higher. Actually, we can probably refi, take some more cash off the table. In one case, I think we can probably take all the cash off the table and still have a good net cash yield. These are big numbers, so why put it through the markets? And so it doesn't mean there isn't a capital event happening, it just might be in the debt world, not the equity world.
Yeah. And that seems to be kind of where we are. I mean, we sort of stick our neck out a bit and say, certainly if there's a vote to stay in Europe, actually the second half of the year, actually 2017 might not just be better than 2016 for the UK, but for everywhere else in Europe. The more pressure is on pricing, the more a few sellers do come through, the more people think, well, actually it's time to bank the gains. And that's clearly not happening at the moment.
Well, it's interesting, again, talking to a PE player a few weeks back now, talking about, look, we had a fantastic liquidity window, beginning of 14 to the middle of 15, and that kind of eased. And we saw that in the figures, we're continuing to see it. And these things tend to be 18 months to 2 years long, and when those ease, you then have another 18 months to 2 years where it's a bit quiet, and then it comes back again. Now, I'm not sure how sound that is, but there's certainly a feeling. You've certainly seen it in the kind of 10, 11 goes quiet again, 14, 15 is good, goes quiet again. So, and that would then perhaps point to things getting better sometime in 17, just on that kind of cyclical play. Well, if you've had some sort of particular sort of events or fear of events around the middle of this year and into the second half, particularly with continental politics, you could well see that return of liquidity, particularly when you look at how much money people have raised to deploy. You also look at the improving sentiment environment for real estate debt. We're actually now in a situation where lenders actually really want to get out there and lend. And unlike the second half of last year, where people say, well, we've done our figures, we don't need to rush, and there was actually a little tightening there. Now everyone's turning around saying there aren't many deals to back. We've got to, how do we lend?
Yes.
So, you've got some drivers there that could, actually make life quite interesting in terms of capital availability later in the year and into the beginning of next year.
All assuming the economy behaves and the occupier market
now,
behaves.
where's the occupier market? You're closer than I am.
Well, it's a bit, I wouldn't say it's dull exactly, but it's quite positive. It's flattened off, but it's flattened off at a very high level. There's central London office leasing, practically the same Q1 this year as Q1 last year as Q1 the year before. All well above the long-term average. No sign of everybody leaving en masse to go to Frankfurt or Paris. Not that they tell us, but they seem to be still signing on the dotted line. The rest of the UK actually seems up, if anything. The occupier, well, I guess, signing a lease is not something you take lightly. You don't make policy off the hoof on these things. It's bound to have some effect on the margin, but it's hard to see in the figures.
Yeah, and it's interesting. There are arguments that have been run that people would be much more nervous about signing leases, much more nervous about signing longer leases, because you're going to have that accounting effect of putting all leases on balance sheet. Now, they've been talking about that since I was a young accountant, which was quite a long time ago. They're actually going to do it this time. They really are. And the difference it makes to corporate balance sheets is extraordinary. Actually, the balance sheets now look like the one the credit analysts have been using for years and years anyway. They actually, the real ones. So maybe it doesn't make that much difference, but it's a mindset change. But are we seeing that change in people's behaviour over their leasing activities?
Not obviously at all. Not obviously.
So what this then says, I almost, I think last time round I said I'd return to my real yield spread, which I think is to be honest, it really is how I think about life in terms of, where is the value? And you're looking at it now, the long-term average between UK average prime yields, CBRE numbers, and real BBB interest rates. The average is about 2.4 spread. It's now 4.8, which means 5-year interest rates, for example, could go up by 2.5% nearly, and you still would only be at long-term average relationship. That's a lot of padding. You've also got within that, you'd probably, if you did have that environment, you'd probably have higher inflation expectations than are baked into the number. So you've probably got more than that, and credit spreads are no worse than long-term average at the moment. So again, you may have some more in that too. So, does this tell me that real estate is not expensive compared to the other calls on money? Right. Perfectly the opposite. So the question is, does the bit that pays the income stay sound, which is the occupier bit, the underlying economy? And whereas there's a lot of trouble out there in the world in so many ways, are we sitting here saying that we think that we are actually in the UK or in continental Europe about to re-enter a recession? I think the answer is no, isn't it?
It can always happen, but it doesn't look like at the moment. I mean, the way you look at the market is interesting. We look at the same figures, slightly different spin, but really that corporate bond spreads have come off, more liquidity in the market, less uncertainty in the market. Interest rates have actually kind of gone sideways down a bit in the UK, but the expectation of going up has disappeared for now.
Completely.
It could be to do with inflation expectation, who knows? But you're at this point where property looks, I keep saying, absolutely expensive, relatively cheap. And the longer it stays like that, it's been like that for a while. This is not
a new fact.
Yeah. The more institutional cash targets property, the more other investors are looking for the kind of bond-like return target property as well. So I think we moved on maybe from the opportunistic investment playing the yield shift to one where you're actually playing the return.
Long-term capital values and income-driven investment strategy. I think that's right. I think that's what you'll see. I mean, you've seen some of the largest historically private equity houses now raising quite large quantities of core plus money to play income strategies. So, that is very much with the zeitgeist.
That's right.
And I suppose that the thing that I look at is that if you actually look at yield behaviour, the period when UK yields were coming down at their sharpest in the last short few years was actually when rate expectations were going up at their strongest. It was kind of second half of last year and so on until a little bit before, when people actually turn around and say, look, I think rates are going to go up. Because you get that virtuous circle effect that the things that are good for real estate income tend, and therefore people's growth expectations and their willingness to bid yields down in the expectation of better income in the future, the equivalent yield effect or whatever, tends to correlate with things which are likely to mean rising rates, particularly from the historically abnormally low levels now. So,
okay, just to finish off, we can't not talk about it now. 23rd of June, CBRE property bike ride. No, something else happening. Sorry, EU referendum. What if it's a vote to leave? Very quickly, what happens in July?
A greater period of instability. And instability, as we're seeing right now, does not tend to aid decision making. And I think that certainly in the very short term, and even the most optimistic views of life, say if you get a vote out, even if life's going to be wonderful into the future and if you put your Boris wig on and everything's going to be fantastic, it does say it'll be weaker in the short term across the board. And I think that's hard to escape just because of if you do get the vote out, you've then got a 2-year period where you've got to try and reshuffle all the cards or rearrange the deck chairs or whatever it is one's doing. And that's hard to paint as being a certain and concrete environment in which to make decisions.
Yeah, that's absolutely right. Look at all these studies that keep coming out every week, every day it seems these days. The only thing they've got in common is bad in the short term, not as bad in the long term, whether it's absolutely better or just not as bad. It varies. Well, interesting investment market, but certainly works with everybody.